It's Mitch and Chris. They're here to talk about SPACs and IPOs, demystify the hype, tell you how to make some money. Chris, I see you. You got your
Hey,
camera
what's
on.
going on, Neil?
Not too much. Having a great Friday here at the Benzinga Boot Camp. It's great to have you. You guys are looking dapper. You guys are looking good. Okay,
Look at
Chris, can
that.
you
Look at that.
look at yeah, okay, we got a close up on the tie. I like the black on black on black with the red tie. Very, very nice. Mitch looking classy. We got this is the
It's time for
formal
the
wear.
SPACs attack, baby.
Let's go. Let's go. All right. So, gentlemen, you guys know what you're here to talk about. I would just love if you guys could tell our audience who you are, a little bit about your background. We'll start with Chris. We'll go to Mitch, and then Mitch wrap us up after Chris gives us his intro by telling us what your folks can expect to learn. So, Chris, tell us about yourself. Where are you from?
Awesome. Thanks, Neil. Yeah, Chris Katje here from Grand Rapids, staff writer for Benzinga, and of course, co-host of SPACs Attack right here on the Benzinga YouTube channel.
Hell yeah. Mitch?
All right, guys. Well, I'm coming out of the mountains, so, remote working, but creating them Raven fans, working hard on technicals. And the name to my game is The Story is Everything. All right, guys. So today we're going to teach you all about SPACs, and then we're going to touch a little bit about IPO. At the end of the day, you guys have been seeing this kind of unmastered asset class, really, especially in the coverage. So we're going to get right off the bat. Chris, go ahead and let us know, what is a SPAC and why are they so trending right now?
All right, guys. Yeah. So one of the hottest investing stories of 2020 was the rise of the SPAC. So while SPACs have been around for years, the number of offerings and money raised hit record numbers in 2020 and is showing the same strength into 2021. So a SPAC stands for Special Purpose Acquisition Company, also known as a blank check company. So SPACs operate differently from traditional IPOs and have been one of the hottest ways for private companies to go public. So SPACs offer units, which include a common share and a portion of a warrant. The unit's typically priced for $10. That money is then put into a trust, and the company has around 2 years to find a target acquisition. Over this 2-year period, the stock trades through several waves, which we are going to now take you through with some charts.
All right, now go ahead and hit the share here. Everything's looking good there. So let's go ahead and get started. So one of the things that I want to mention, guys, is that there's waves to this game, guys. So if we really take a look, this is going to be the guide on how the waves kind of move here. So let's get right into it. The first wave, guys. First, we get into kind of this S1 period. This is when, the stock kind of goes through its, I would call it the beauty contest. What ends up happening here is that they're presented to top investment banks. And based on the team and track record and industry knowledge, now they go ahead and team up with an investment bank. And then what they do is they finalize their investment deck, the financial model, and get the pipe running. Once the pipe's running, we got the usual large investors filing in here. And so the S1 is kind of the sideways period. Then we get into the rumors period where it really starts spiking up. This is kind of the first wave that leads us into the second wave, where we start really kind of getting into more of the rumors and the S4, which is that vote date announcement. So usually you're going to get kind of a little bit of a run in that rumor time, but a lot of the times they can kind of die down right before the vote date. So this is when you start seeing that spike. That's the second wave. Then we get into the third wave. The third wave is that vote approved, the merger announcement. A lot of times you're going to start seeing this down effect after that wave. And this is just the patterns that we're seeing, guys. It doesn't mean that every single SPAC is going to do this, but these are the patterns that we're seeing. So we're definitely going to point it out. Best way to point it out for you guys is to understand that after this, they go through an evaluation period, and there's going to be a fourth wave. And the question is going to be is, it all depends on the investors and the evaluation period. So let me show you guys a little bit more here. So the S1 filing here, this is on SPCE. This is one that did the move all the way back in 2018. So you're not talking about the kind of the same trending SPACs that we're seeing here. So one of the things is you see the sideways period. This is the same thing we talk about. then a spike on the rumor, and we'll bring you a little bit closer so you can see this. So that you get this spike on the rumor here, and then a lot of the times it kind of dies down right before the vote's announced, and then you get that spike going into the vote. But a lot of the times what we're seeing is after that vote is actually approved, we're starting to see this downward period. So the timeline, once again, guys, we first start going with the S1 filing, that public offering. We move into the rumors, and then we get to that S4 vote date, and then finally to that vote approval. Let me show you guys one more chart, guys, so you guys can see this clearly and defined. So this is Desktop Metals was at 1 point TRNE. So here you got the S1 filing back before this March period, kind of sideways period time when it goes at 10. And then the rumor really started kicking this one off after that 10 period. It actually spiked a little bit, but pulled back. And then you guys see here the vote date announced here and really start driving it up. But we'll pull a little closer here so that you guys can see it. And you can see this vote date right here. It really starts spiking things up, but then you get this kind of leveling down period. And then look what happened on the vote approval, guys. The vote approval was right here on this green candle here. And right after it, knocked right back down. I think this is when you got to go ahead and ask yourself the question, guys. There's waves to this game. And after the vote approval is done, you need to ask that question. Is there going to be that fourth wave? The fourth wave is all really about the evaluations. And this is when fundamentals really kind of take over, and it really is all going to depend on the investor at this point to see, if you see that evaluation and the fundamentals actually kind of match the business. So you want to go ahead and add anything here, Chris?
Yeah, if you want to go back to the SPCE chart. So I want to talk about another key point. So with SPACs, there's what's called the $10 floor. So these units go public at $10. And one of the things with the merger vote is you can actually, if you don't like the deal or if shares are below $10, you can actually, vote no, and you get your $10 back plus interest. So as you look at that flat movement on SPCE, it was protected by that floor of $10. But once the vote went through and it became Virgin Galactic, shares actually went below $10. That's not something we're seeing too much now with SPACs, but it's important to note that once that deal goes through, you're no longer protected by that $10 floor. So here we have, shares under 10. And now, of course, Virgin Galactic went through that fourth wave, and is trading higher than it ever did during the SPAC period. And then on Desktop Metals, so similar thing where after that deal went through, we saw shares go way up on the announcement. And then after the vote was approved, they significantly dropped. And then they went up again and then down. And now they're starting to climb up again. And part of that is, you're getting analyst upgrades and ratings. You're getting, CNBC coverage and stuff like that. So it's important to pay attention to the story. But the patterns on SPACs have become very similar with them dropping, after these merger vote dates are through. And remember, you're no longer protected by that $10 floor level.
Yep. And that's when you're going to go ahead and ask yourself, is there going to be a fourth wave? You have to ask yourself and also start looking into the companies. After that merger vote, I think that's when the fundamentals really kick in for these. It's no longer a momentum stock just trading off the technicals, and you have to do your research there. All right, Chris, let's get into the IPOs.
Yeah, so traditional IPOs, is the other big way to go public. And SPACs have taken a little bit away from that, but it's still a very popular way for these private companies, to hit the public market with their offering. There's some big differences, though, with IPOs, and that's what we kind of want to illustrate on these charts. So I'll let you hit on this first one here, Mitch.
All right, guys. So Airbnb, we're going to talk about IPOs here. And the main thing we're trying to point out is that you have to be careful with IPOs because a lot of them kind of open up at a premium, and this is when you got to be careful. You can definitely get caught in some of these if you're not paying attention to kind of where they should have been priced versus where they're opening. And what do we see here from Airbnb, Chris?
Yeah, so Airbnb, their original pricing range was $44 to $50. They priced shares at $69, and then they opened for trading at $168. So 70 million shares were traded on day one. You can see that with that bar at that bottom here on Benzinga Pro. And then day two, only 27 million shares were traded. So again, there was huge interest in this name that shot shares up way above the offering level, and that huge volume spike. But then the next couple days, as volume declined and the interest waned, shares started falling down. So it's important to know, if there's an IPO that you like, a company for the long term, day one might not be the time to get into this name, because most likely you're going to see that drop off because people, they get in at the offering price or shortly after. They're going to take profits as, this company price shares at 69 and started at 168. That's more than a double just from going public and, starting trading there.
Yeah, we don't see only this pattern showing up here in Airbnb. We could also talk about it in Dash here. We could pull up this chart here. So DoorDash, also another one that opened up at a high premium. What happened there, Chris?
Yeah, so DoorDash, their pricing range was $90 to $95. They priced shares at $102 and then opened for trading at $182. So again, almost a double, just from hitting the public market from their pricing. So they hit a high of 195.50 and closed at 189.51 on day one. So actually traded and closed above their opening range. So volume was 25 million day one, but then it dropped to 9 million on day two. And as you can see over the next several trading sessions, shares went down again, as people sold off. And this one actually dropped for quite a while before we're now starting to see that upward movement into DoorDash. And remember, this came, during the pandemic when food delivery has grown. So still, just because it's a hot name and a hot industry, that day one might not be the time to get into these IPOs, as there's that pattern going on here.
Yeah, one of the things that I definitely am seeing here from this pattern is that you have to be careful, like Chris is mentioning, day one. Day one is probably going to be the day where you're going to see the most volume traded on the stock. Probably, you could see it here on Dash. It hasn't even gotten close to that kind of volume. So definitely you got to be careful on then, because what happens here is called price discovery, and no one really knows where this stock should be priced at when it opens here. Okay, so let's go ahead and one more look. We got Woof here. Woof. I thought this was they did some really deep thinking in naming this ticker, right? So let's go. Let's check out Petco here. Health and wellness. What happened here, Chris?
Yeah, so Petco Health and Wellness, they priced at $18, which was above their range of 14 to 17, and then opened for trading at $26. Hit a high of 31, but closed at 29.40 on day one. This one, the volume was actually 52 million shares on day one, but only 14 million on day two. So this one saw even a bigger drop off in terms of volume. And as you can see, this is a newer IPO, but it hasn't gotten close to getting back up to that day one value that was set. So again, you're going to see it trade, down until we get some sideways momentum before this thing starts going back up again.
Yep, perfectly. And I'm going to point out a pattern here for all three of those after that I've just literally just seen, and that's how it is, you guys got to see the patterns. So let's go into one that I do want to mention about, one that actually didn't open at a premium but at a discount. And so let's talk a little bit about Corsair Gaming here.
Yeah, so Corsair Gaming, CRSR. So this one went public, priced their shares at $17, but then they actually opened at $15.12. So this thing, it went public, and then it hit some catalysts later on. So it started getting more volume, and as you can see, the volume was actually higher, a couple months down the road, and that had to do with the release of the PlayStation 5 on November 12th and the Xbox Series X on November 11th, because this became, a gaming peripheral play. So then when you saw that volume increase, you also saw, shares start to go up. So it's important, where you see a name like this, where it actually opened below the offering price and then gave an opportunity in those first couple days to actually trade higher. So, that's another pattern to follow when shares open below the offering price.
Yeah, this is a great lesson. I mean, full disclosure, this was the one that I really wanted. So I kind of was kicking myself a little bit because I didn't get in on this second day. And really the key here was I was a little stunned when it actually opened up a little lower. We're used to seeing the premium trade. So when I saw the discount, I was kind of concerned on what was going on here and what the institutionals thought and why it was opened up lower and not at a premium price. So one thing that you definitely saw is, like Chris mentioned, I think this one just perfectly timed the market. This is another thing that we can mention on IPOs is that timing is so important in these IPOs, because if you get the correct timing with the right catalyst, then like I said earlier, guys, story is everything. So in this one, the story was right out the open that streaming plays were hot. I mean, if you take a look, you probably saw Zoom ripping through probably some monster number, either 400 or 500 near this time. And then you saw other streaming plays really getting kind of the attention. You saw Logitech ripping up, and that's why I was paying attention to these. One of the things to mention is that if you do your deep dive in the IPOs, you might be able to find a lot of information that could be beneficial to understanding the company. So one is in Corsair Gaming, you have Elgato Gaming. Elgato does a lot of the streaming tools that we're using every day. And a lot of us use kind of the Stream Deck, or we're using a video capture card, and you saw these plays really taking off. That's what gave it the first ride. And like Chris mentioned, once the video gaming's got hot, that just increased the story and gave it some more lift. And this is all about timing. They released it at the right time, and thus the catalyst really gave it that driver to really get it on up there. It went all the way up there to $50 price point. And now, you're starting to see that bottoming action. And this is kind of what you want to see on an IPO is that when it goes ahead and does that breakout, can you get the sideways consolidation period to kind of determine between the bulls and the bears, and no one getting control. And then you'll see if the bulls can go ahead and regain control and rip this one up. This one did an offering here at about 35. So, we'll take a look at this one, but really want to point out really quickly what's called the undercut and rally. And you can see it on all three of these other IPOs, where it opens up here and the low actually gets undercut, and then the stock rallies. So if you look here, you'll see the same look on DoorDash, the undercut and then the rally. The same thing happened on Woof. I would expect for kind of to get right below this and then look for maybe a rally to come back later on. The real key is it's all about price discovery and where you're getting that volume to come back in it. All right, guys, so I'm going to go ahead and pull the share down here. And like always, guys, if you guys want to hear more about what we do, and we do this every single day, we teach on SPACs and IPOs. We go ahead and touch executives, experts in the industry. We have interviews all the time, guys. So if you haven't tuned into the SPACs Attack, that's an everyday show starting at 11 Eastern. Anything you want to go ahead and touch, Chris?
Yeah, so I'm seeing some questions here. So one of them was about warrants. So warrants in those unit offerings. So a typical warrant is for a stake price of $11.50. So a warrant similar to an option, where it gives the investor, the opportunity to get a share later on at $11.50. So when these SPACs, over the last couple of years weren't as hot, you were seeing these units offer, like a full warrant, a half warrant, or a third of a warrant. So you were buying units at $10, and then you were actually getting, a portion of a warrant that you could, convert to a warrant later on. So it gave you kind of an extra incentive or value to buy those units. And then 52 days after the units go public, you can split them into common shares and warrants. So warrants are a little bit, high risk, high reward, where if a common share is up 2 to 3% one day, warrants may be up 20 or 30%. But again, it's about that $11.50 price. The thing with warrants, though, is they do expire, worthless if a deal is not done in those 2 years. And you also have to pay attention in the offering, because some companies write in there that they can call warrants when the shares reach a certain price point, which may limit the upside. So it's different things to look for. Each unit is different as far as terms of warrants. And then I saw S1. So there was a question about S1. So SPACs is the same as IPOs. They have to file their S1 with the SEC. So you can find these on the SEC website. They'll issue their S1 that they're going public, and then they'll issue an amended one later on, and then they'll typically start trading a couple days later. So we talk on the show different things to look for. In the S1 is the terms of the deal. So it'll show how many units are being offered, what the price is for those units, what the warrant terms are, how many warrants you get. Then it talks about the management team, which is one of the keys here with SPACs. Is it shows, if the management team has ever done a SPAC before, if they've ever been, a CEO or on the board of a public company, if they're with a private company, or if they're with a hedge fund or an investment group, what companies have they invested in? So that's another key to look for. And then they also talk about, their sector that's targeted. So if it's people, with a lot of banking experience, that's probably going to say in the filing that they're looking for a fintech acquisition target, because that's their area of expertise, and those are all important things to look for, as it kind of gives you a sense of, hey, this management team's really experienced, or, hey, I remember this management team brought DraftKings public via SPAC, and now they have a new SPAC. So I want to invest in that. So just different things to look for in the S1s. Then I was trying to see other questions here. That might be it.
I think that's all the questions I see in the chat there. But let's touch up our watch list that we touch up every day on the show, right? So one of the things I'd mention is this CCIV, guys. This is one that we look at all the time, guys. And what happened here, Chris? What happened in CCIV?
Yeah, so CCIV had a rumor that they're going public with Lucid Motors, so an electric vehicle company. So as you see, this thing traded flat, at that $10 price point. This is a Churchill Capital SPAC from Michael Klein, who's done several deals before, but there just wasn't a lot of interest in it. And then all of a sudden, these rumors, perked up that it was an electric vehicle play, and shares shot up on that rumor. So now you have these trading.
All right, guys. Looks like I lost Chris there, so I lost you there for a second, Chris. You there? Good?
Oh, so let's say this one doesn't, get a deal completed in the next 2 years. These shares then, are essentially worth $10. So you lose that value up above 10. But let's say they sign a deal with Lucid Motors and the market positively reacts, you could see shares go higher. So that's why it's important with some of these SPACs to kind of look at that $10 to $11 price point, because it limits your risk. Your downside is limited, and it's important to kind of look at that floor.
Yeah, definitely. You guys, this is one that we mentioned on our $10 to $11 show. This is something that we talk about all the time on SPACs Attack, is trying to get as close towards that $10 price point as you can, so that you can measure your risk. I mean, at the end of the day, that's what we want to all do, is want to be, risk adverse and be able to manage our risk here in these kinds of trades. So let's go into one more here. Let's touch let's do QS. I want to touch this one. This was a monster SPAC, guys. So tell us what happened here, Chris.
Yeah, so QuantumScape, a battery company, went public with Kensington SPAC. So this one, as a battery play, lots of interest as the thing behind the thing for EVs. Huge interest in it. It traded really high going into that merger vote date. And then after that deal went through, we started to see shares, sell off. And then the other thing was, all of a sudden, they had more shares hitting the market from the investment group that, brought this public, warrant conversion. So more shares, increased the float. And all of a sudden, this one started, dropping like crazy. So here we have, that huge downward move in this one.
Yeah, you know what I'd point out about this one is that, and Chris and I point this out all the time, guys, is you got to know your levels on these. You know, if you don't know your levels, that's how you get caught often. You know, is that if you can go off of support, a lot of the times you're going to be able to see support come into these stocks. And we talked about the fourth wave. You know, where you're seeing QS now is kind of getting near that fourth wave, where people are really starting to try to evaluate this company so that they can understand where the pricing is, the fundamentals matching, and then it's going to be all about kind of this technicals and timing the market. All right, guys, we want to go into one last one here, and that's Helion. Why? Because, you know, that's actually the chart that I was showing you guys earlier when I was doing my presentation of the waves. That was this down wave that you saw, and I think this was the biggest kind of turnaround from a vote date that you could see. Would you kind of agree, Chris?
Yeah, I mean, this was one of the hottest SPACs over the summer of last year. And then, you know, it shot up into that $40, $50 range. And then after that vote went through, you know, this one just started trading down, you know, right away. And the big thing with this one was, you know, the story. It was all about the opportunity of Helion down the road with their technology, retrofitting these big trucks. And, you know, people just weren't interested in this one. And the other thing that happened here was there was a significant number of new SPACs hitting the market to where people were rotating, right? So they were selling this one to lock in their profits, and then they were getting into newer SPACs. And that's something we're seeing now with the large number that's offered is, you know, and again, depending on your own risk profile, it may be wise, you know, on some of these deal announcements, sell on the news, take your profits, get into a different SPAC, limit that risk downside, you know, by finding these ones between 10 and 11.
Yeah, definitely. You know, one of the things I'd mention is that, you know, a lot of times with SPACs, we talk about the board, right? And I would personally have to say that there's probably has been no other stronger board than Chamath. Would you kind of agree here, Chris?
Yeah, I mean, Chamath Palihapitiya, definitely SPAC king, you know, called that by everyone. You know, he's brought 6 SPACs to the market. He's completed deals for 3 and a pending deal for a 4th, but then he also invests along in the pipe on some of those other offerings. So he's had big success, and he's also drawn lots of investors in, you know, to get into those deals that he's done. So, you know, it's important, yeah, to look at the management teams. And you can find that right in the S1, guys. You know, it'll say Chamath Palihapitiya, it'll spell out in the S1 filings all the SPACs that he's ever done. So it'll say, you know, IPO A, IPO B, IPO C, and then it'll also say that he was a member of the pipe on other ones. And sometimes it'll say right in the S1 how well those performed, you know, and if they're trading above where they were before, or you can just go type in the ticker into Benzinga Pro, pull up the chart, and you can see, hey, he had success with all these SPACs he's done. This is the management team that I want to get on board with. So that's why it's important in the S1, look at the management team, look at their history in SPACs. And if they don't have a history with SPACs, look and see what companies they worked with. Maybe they were at, you know, eBay or PayPal. They helped grow that company. So they've never been with a SPAC before, but they have, you know, they have the knowledge and the history of growing an e-commerce company, and they're targeting e-commerce. So maybe that's who you want to get behind.
All right, excellent. So looking like we have a question here, Chris. Go ahead and recap again what sections you like to concentrate in the S1 filings.
Yeah, so the S1 filings, you know, we pointed out on a show 4 big areas that I look for. So it's the terms of the deal, which tell you how many units, how much money they're raising, and then the warrant terms, and then the management team. And then if the management team has done SPAC deals before, I want to look and see which SPACs they were, how they performed, you know, with the public market. Did they perform well initially off the deal? Did they perform well after the close? Are they performing well now? And then I want to look at the sector targeted. So is this electric vehicles, you know, a hot sector, or are they targeting, you know, something, you know, that's going to be less trendy to the market and maybe won't catch on? Are they targeting a certain country? So we've talked recently on the show about how some of these SPACs have listed that they're targeting Israel as an area, and we are seeing a large number of private companies from that country want to hit the public market, and some of them have had huge success. So if I see a team, that lists that, that's something that excites me about the S1.
Yeah, one thing that I always try to follow is trends, right? Social trends. And we're also seeing social trends affect SPACs. We could talk about EV vehicle plays. We could talk about maybe the thing behind the thing and battery plays. We could move into different areas, whether it be mortgages. You have to follow the trends, guys. And then what you're going to start seeing is that if I can follow the trends, maybe I can get in front of these and maybe get closer towards that $10 period and kind of hold until we get that merger. And then if, worst comes to worst, if you're close towards that $10 period, like Chris mentioned, if, you vote no, if you don't like it and you get your $10 back, and I think that's the important part is the risk management here and the potential for returns. So like always, guys, try to stay with the trends. Like one that I'm in, full disclosure, guys, CTAC, 5G kind of plays. You have to try to get in with the news flow so that you can kind of understand these and then maybe get in a little bit earlier.
So I see a great question here. And this is one that I think is going to change possibly in 2021 with a new SEC chair. So it's asking, how do you find the percent ownership for SPAC investors will have in the new company? So when a SPAC deal is announced, there's normally a press release and then an investor presentation. Right now, the percentages you can't find in that press release. They're in the investor presentation on one of the slides. I think eventually we're going to see this listed in the press release, but this is important to note. So, sometimes these SPACs, the investors in the SPAC, the common shares, the common investors will get, 10 to 15% of the new company. And then other deals, so like we just saw United Wholesale Mortgage go public, of GHIV, that SPAC, we're getting less than 3% of the new company post-merger. So it's important to note that because it kind of shows the value. And then also you have to take that into consideration when you look at the market cap. So, it'll show what the market cap is, but that's only for the shares, that are commonly out there. That doesn't mean that if a SPAC's being done at a $10 billion valuation, that SPAC should trade for $10 billion. That's a common misconception out there. And you want to pay attention to that investor deck that lays out the percent that common shareholders get, that the founders of the company get, that the PIPE investors get. It's all right there in that investor presentation. And it's something to definitely look at, because maybe you want to be in a SPAC where investors are going to own 20% of the company going forward versus a company where the founders are going to, own 90% of the company, because then, the common shareholders, don't have as much rights going forward. So that's something to look for there.
Yeah, definitely just keep up with the trends, guys, and then you'll be able to find these trends early. And one of the things is, like I talked about, there's waves to the games, guys, and you don't want to get caught on the top wave. You want to be trying to get that scoop, trying to get that support, because that's when you're going to go ahead and get your best risk to return entry.
Guys, I love it. What a great overview. SPACs and IPOs, Chris and Mitch. Guys, there are two things that I want to hear from you. Number one is, if there's one thing that you want everyone to walk away from this presentation with, what is it?
I would say to be risk adverse in these, to try to get as close to that $10 price point. And that's what I do every single time I get in, guys. You guys were very rarely, I think maybe a 1% chance to hear me grab a SPAC that's above, let's say, a $15 price point. That's just to give you guys that warning to definitely, do the research, do the investor deck. We bring the investor deck to the interviews for a reason, guys, because there's information there for you guys. So definitely that's what I would say. Chris, what would you say?
I would piggyback off of that, say again, the risk reward profile. So I would say look for that $10 to $11, and then don't be afraid to take profits when these deals are announced as you see the patterns. So it's, you know, there's nothing wrong with taking some profits, hit some singles, hit some doubles. Don't worry about hitting those home runs all the time and the 100% gainers.
Good. Those were great. Very, very actionable insights. Guys, thank you so much. Where in the world can our audience find more of you? Where can they hear more of what you guys have to talk about?
Hey, like always, guys, if you guys want to see the brains of the show, this man right here, Chris Katje, guys, and me, myself, you know, try to do some technicals. We break it down every single day, whether it be executive, experts, or also information.
Where though, Mitch? Where?
On Benzinga's YouTube, of course, every single day, guys. So definitely hit the subscribe.
Monday through Friday, 11 a.m. Eastern time on Benzinga YouTube. You can find SPACs Attack. And then if you're looking for more SPAC coverage, you can hit up the Benzinga website. And I try to get articles on there about all the deals that are done and some trading ideas as well.
Hey,
top marks, Chris. Top marks. That's how it's done.
And of course, guys, add us on Twitter. You got Story Investor here, and you got at Chris Katje here. So, you know, we engage with you guys outside of our show. So if you guys want to engage with us, definitely hit us up.
Wonderful, guys. Thank you so much for joining us for this boot camp.
Thanks, Neil.
And have a great day. Thank you. Next up, we're going to talk about cryptocurrency, guys. The currency of the future.